Welcome to the Property Wealth Podcast. Today, we're diving into a really exciting topic that's gaining a lot of traction. Syndication. Partnering with others to tackle bigger real estate deals.
Yeah, absolutely, Sarah. Syndication can be a game changer, especially for those of us over 40 looking to build that long-term wealth.
Right? It's all about pooling resources and expertise. And it opens up opportunities that might feel out of reach when you're going solo.
Exactly. We'll chat about how syndication works, the benefits, and some potential pitfalls to watch out for too.
Oh, and we'll share some practical steps to get started so listeners can feel empowered, no matter where they are on their investment journey.
That's the key, isn't it? Making sure everyone feels like they can take action, even if they're just starting out.
For sure. And we'll also touch on how to find the right partners and set up those crucial agreements.
It's all about building trust and creating a solid foundation for success.
So, whether you're looking to invest in a multifamily property or even a commercial space, this episode is packed with insights to help you navigate the world of syndication.
Let's jump right into it, shall we?
Let's do it. So first off, Mike, could you give us a brief overview of what syndication really is and how it typically works? So Mike, why does syndication really matter for folks over 40 right now? I mean, it feels like a pivotal time with so many changes in the market.
Absolutely, Sarah. For people in that age bracket, retirement timelines are getting closer, right? Many are starting to think about how to secure their financial future, and syndication can be a powerful tool in that regard.
Right? It's like a way to leverage resources, isn't it?
Exactly. Many of us over 40 have accumulated some savings, but we might not have enough to buy larger properties outright. Syndication allows us to pool our resources with other investors, which opens up opportunities for bigger deals.
Yeah, and those bigger deals can often lead to more significant returns, right?
For sure, and let's talk about inflation. With rising costs, investing in real estate is historically known to be a good hedge against inflation. When you invest in a property, you're not just buying a physical asset. You're also investing in something that tends to appreciate over time.
That makes sense. So if you're in a syndication, you're also benefiting from that appreciation, even if you're not the sole owner?
Exactly. And here's an example. I worked with a couple, let's call them Tom and Lisa. They were both in their late 50s, looking to diversify their portfolio before retirement. They'd been in traditional investments like stocks, but with the market volatility, they felt uneasy.
Totally relatable. It's hard to feel secure with your money when the stock market is all over the place.
Right? So they decided to look into syndication opportunities. They found a group investing in an apartment complex in a growing area, and they didn't have to put up the entire amount themselves, just a portion.
That sounds like a great way to spread the risk out.
Exactly. They teamed up with a few other investors, and now they're not only earning passive income, but also participating in the property's value increase over time. It's a win-win.
And I can see how this can ease some of the financial anxiety people might feel as they approach retirement.
Yes. Knowing they have a steady income stream from real estate can provide a lot of peace of mind. It's like a safety net. And, with the current economic trends, having a tangible asset is more valuable than ever.
Right. Especially with the uncertainty we've seen in the last few years.
Exactly. And there's also the emotional aspect of financial security. I mean, it's not just about numbers, right? It's about feeling secure and knowing you're setting up a legacy for your family.
Oh, for sure. I think a lot of people want to leave something behind for their kids or grandkids. It's not just about retirement. It's about generational wealth.
Exactly. And syndication can help facilitate that transfer. For example, say someone invests in a syndicate and earns a consistent return. They can use that income to fund their kids, education, or even create a trust.
That's such a powerful way to think about it. And it's not just about making money. It's about creating opportunities for future generations.
Yes! And let's not forget about market shifts. With the real estate market evolving, there are often unique opportunities that arise. Syndications can help investors tap into those without shouldering all the risk.
Like when a new development pops up, or there's a sudden demand in a certain area, right?
Exactly. And by pooling resources, the group can move quickly to capitalize on those opportunities. It's about being agile in a changing market.
So for someone over 40, this could be a way to stay relevant in the investing game, right?
Absolutely. And the beauty of syndication is that it allows investors to learn from experienced operators in the field. When you partner with seasoned investors, you get insights that can help you grow your own understanding of the market.
That sounds like a great way to build knowledge while also building wealth.
It really is. And then there's the added benefit of community. Investors in syndicates often form strong relationships. They're sharing experiences, learning from one another, and sometimes even forming lifelong friendships.
That's a nice bonus. It's not just about the money, but also about the connections you make along the way.
Exactly, and in a time when many are feeling isolated, investing in syndications can create a sense of belonging. Plus, you're all working towards a common goal.
It's like a team effort. So, if someone is intrigued by this idea, what's the next step?
Well, that's where we'll dive in next, exploring some core strategies on how to get started with syndication, what to look for in a partnership, and how to ensure that it aligns with your long-term goals.
I can't wait to dig into that. It's going to be really helpful for our listeners.
So, let's dive into some core strategies when it comes to syndication.
Yeah, I think a lot of people are curious about how to partner effectively on bigger deals. What's the first thing they should keep in mind?
Well, one of the first things to consider is the 1% rule. It's a simple way to gauge if a property could be a good investment. Essentially, the rule suggests that the monthly rent should be at least 1% of the purchase price.
Right. So if you're looking at a property that's, say, $200,000, you'd want to see a monthly rent of around $2,000?
Exactly. That gives you a quick snapshot of potential cash flow. But remember, it's just a rule of thumb. There are other factors to consider too, like location and property condition.
And what about the 50% rule?
Ah, yes. The 50% rule is another quick way to estimate expenses. It suggests that about 50% of your rental income will go towards operating expenses, including maintenance, property management, and taxes.
So if that same property rents for $2,000 a month, you might expect around $1,000 going toward expenses?
Precisely. That leaves you with a potential net income of $1,000 a month before financing costs.
And then there's the cap rate, right?
Right. The capitalization rate helps you assess the profitability of an investment. To calculate it, you take the net operating income and divide it by the property's purchase price. So if your net income is $12,000 a year on that $200,000 property,
that would give you a cap rate of 6%.
Exactly. A 6% cap rate is often considered decent, but it really depends on the market. Higher cap rates can indicate a better return, but they may also mean higher risk.
Got it. So when evaluating deals, what should investors keep in mind?
I'd recommend creating a checklist. Include things like location, property condition, and comparable sales in the area. Look at the historical appreciation rates too.
Right, and what about financing options?
Well, there are several routes you can take. Traditional mortgages are common, but for larger syndications, you might consider commercial loans or even private money lenders.
Private money lenders?
Yeah, they can be individuals or groups that offer financing in exchange for a share of the profits. It's more flexible than traditional banking, but you need to have a solid plan to attract them.
So if someone is new to this, how might they find partners for syndication?
Networking is crucial. Attend local real estate meetups, join online forums, or even social media groups. You'll find like-minded investors who might be interested in teaming up on a project.
And what about property types? Are certain ones better for syndication?
Generally, multifamily properties tend to attract syndication because they provide multiple income streams. If one unit is vacant, you're still getting rent from others.
That makes sense. What about markets? Should they focus on emerging markets or stick to established ones?
A mix of both can be smart. Established markets tend to be safer, but might have higher entry costs, while emerging markets can offer better growth potential, but come with more risk. Look for areas with population growth, job opportunities, and infrastructure development.
And how about the due diligence process? What should investors be doing before committing?
Oh, that's essential. Do a thorough property inspection, review financials, and analyze the local market trends. You also want to check the zoning laws and any potential environmental issues.
So really digging into the nitty-gritty?
Absolutely. And make sure to look at the lease agreements too. Understanding tenant demographics and potential turnover rates will impact your income projections.
And once they find a property they like, how do they structure the syndication deal?
Typically, you'd have a general partner who manages the deal and limited partners who provide capital. The structure can vary, but being clear about roles and profit sharing upfront is key.
So what's a common split for profits?
A common structure is a 70-30 split, where the general partner takes 30% of the profits for managing the deal, but it can vary depending on how much work each partner is putting in.
That sounds fair. And it's important to have everything in writing, right?
Definitely. A well-drafted operating agreement outlines everyone's responsibilities and expectations. It's crucial to avoid misunderstandings later.
So it's not just about finding a property, but about the partnerships and agreements too.
Exactly. And speaking of partnerships, let's transition into some common pitfalls that people should watch out for when syndicating.
Oh, I can only imagine. What's the first one?
One big pitfall is not doing enough due diligence on your partners. You need to trust the people you're working with. If someone doesn't bring the skills or resources they promised, it can really jeopardize the investment.
That's so true. Trust is everything in partnerships.
Another common mistake is underestimating costs. Many first-time syndicators focus too much on the purchase price and forget about the hidden costs, like repairs or management fees.
Yeah, that can definitely add up.
And lastly, not having an exit strategy is a critical misstep. You need to know how and when you plan to sell or refinance your investment.
Good point. It's all about planning ahead.
Absolutely. If you have a solid strategy and stay informed, you'll be in a much better position to succeed in syndication.
Well, that's a lot to think about. I hope our listeners found this advice helpful as they consider their own investing journeys.
So, one of the biggest pitfalls I see with syndication is over-leveraging. I mean, it's so tempting to use as much debt as possible to maximize your returns, right?
Absolutely, Mike. It sounds great on paper, but then what happens when the market shifts or when those interest rates creep up?
Exactly. I had a client, let's call him John, who jumped into a syndication deal with a high loan-to-value ratio. Initially, it looked like a fantastic investment. But then the market took a little dip, and suddenly the cash flow was tight.
That must have been stressful for him.
It really was. John ended up having to cover shortfalls from his own pocket. And the thing is, if you're over-leveraged, that can lead to a downward spiral.
So what would you say are some signs that someone is over-leveraging?
Great question. If your debt service is more than 30% of your total income, that's a red flag. Also, if your monthly expenses are tightening your cash flow to the point where you can't cover unexpected costs, you might want to reconsider your leverage strategy.
Right, and then there are bad tenants. That can be a real headache, can't it?
Oh, for sure. I mean, a bad tenant can turn a dream investment into a nightmare. We worked with a couple, let's call them Lisa and Mark, who didn't do their due diligence. They were so excited about their first investment property that they skipped the background checks.
Oh, no.
Yeah, and they ended up with a tenant who was frequently late on rent, and eventually they had to go through an eviction process. It cost them not just money, but also time and peace of mind.
That's a tough lesson to learn. So how can someone avoid that in the first place?
Well, the key is thorough screening. You want to check credit reports, rental history, and even talk to previous landlords. If something feels off during the interview, trust your gut.
Definitely. And let's not forget about ignoring cash flow. That's a biggie too, right?
Absolutely. I had a conversation with a friend who was so focused on appreciation that he completely ignored cash flow. He bought a property thinking it would skyrocket in value, but the monthly rent barely covered the mortgage.
Yikes! That sounds risky.
It is. When you ignore cash flow, you're essentially betting on future appreciation without a safety net. If market conditions change, you could be left with a property that's costing you money every month.
What do you think are some indicators that cash flow isn't being prioritized?
If you're looking at a deal and the projected rent doesn't cover at least 1.25 times your mortgage, that's a warning sign. Also, if you're relying on future appreciation to justify the investment, be cautious.
And timing the market? That's another common mistake, isn't it?
Yeah, it's like trying to catch a falling knife. I've seen investors wait for the perfect moment to buy, and then they miss out on solid opportunities. I had a client, let's call her Samantha, who thought she could time the market perfectly. She kept waiting, and by the time she was ready to invest, prices had already gone up significantly.
That must have been frustrating for her.
It really was. The lesson here is that it's often better to focus on long-term value rather than trying to time the market.
And then there are those hidden costs.
Yes, that's a big one. Many investors overlook repairs, maintenance, and property management fees. I had a colleague who bought a property that seemed like a steal, but once he got into it, he found out the roof needed replacing and the plumbing was a disaster.
Ouch! Those costs can add up quickly.
They really can. It's vital to get a thorough inspection and budget for unexpected costs. A good rule of thumb is to set aside 10% of your rental income for maintenance.
So what can listeners do to spot these red flags early?
Well, first, take your time during due diligence. Don't rush into a deal just because it looks good. And always run the numbers. If something seems too good to be true, it probably is.
That makes sense.
Also, build a strong team around you. Having a good real estate agent, a reliable property manager, and a knowledgeable accountant can help you navigate potential pitfalls.
So if someone finds themselves in a tough situation due to any of these mistakes, what should they do?
The first step is to assess the situation honestly. If you're over-leveraged, look at ways to reduce debt, like refinancing or selling off a property. If you've got bad tenants, consider mediation before jumping to eviction. Sometimes, communication can solve issues.
And for cash flow problems?
Look at ways to increase income, perhaps through renovations or adjusting rent, and always keep an eye on your expenses.
Those are solid strategies.
Yeah, and remember, investing in real estate is a long game. Mistakes will happen, but it's how you learn from them that really counts.
Absolutely. So let's talk about next steps. What should someone do after listening to this?
Well, first, take a moment to evaluate your current investments. Are you falling into any of these pitfalls? If so, create a plan to address them.
And don't forget to keep educating yourself. The more knowledge you have, the better equipped you'll be to make informed decisions.
Exactly. It's all about building a solid foundation for your future.
I love that perspective. It's about creating long-term wealth without the stress.
Right. So let's keep that momentum going. All right, so let's dive into some immediate steps you can take right now if you're interested in syndication or just, partnering on bigger deals.
Yeah, I love that. It's all about making those first moves, right?
Exactly. First off, I'd recommend getting familiar with some tools that can really help you analyze potential deals. One that comes to mind is the BiggerPockets calculator.
Oh yes, that's a great one. It's user-friendly and you can run financials on properties pretty easily.
Right. You can input variables like purchase price, rental income, expenses, and it'll give you a pretty solid picture of cash flow and return on investment.
And if you're looking for comparable properties, Zillow is fantastic. You can see what similar properties are renting for in your area, which is super valuable for making informed decisions.
Absolutely. And let's not forget about DealCheck. It's another great tool for analyzing deals, plus it allows you to track multiple properties in one place.
So you can really keep everything organized. I like that. What about rent analysis tools?
Rentometer is a good one for that. You can quickly gauge if a property's rent is in line with the market. It's especially useful for those just starting out.
That's a must-have for sure. And if you have access to your local MLS.
Definitely. The MLS can give you a wealth of information about properties that aren't listed publicly, which can sometimes lead to great opportunities.
Right. So those are some tools. If someone feels overwhelmed, where should they start?
I'd say start small, maybe analyze one deal per week. Just pick a property, run the numbers, and see what you come up with.
That's such a practical approach. And it's not too daunting, right?
Exactly. It keeps it manageable. Also, consider joining a local real estate investing meetup. Just being around like-minded people can open up so many doors.
Networking is key. You can learn from others, experiences, and maybe even find potential partners for syndication.
For sure. And if you want to dive deeper into the subject, there are some great books out there. The book on managing rental properties by Brandon Turner is a favorite of mine.
That's a solid read. It's really practical and covers a lot of ground for new landlords.
And then there's Real Estate Investing for Dummies. I know it sounds cliche, but it really breaks down the basics.
I think it's important to emphasize that these books can offer a lot of foundational knowledge, especially if you're new to the game.
Exactly. Podcasts are also a fantastic resource. I'd recommend Bigger Pockets podcast for some great insights on real estate investing.
Yeah, they have a ton of episodes with real-life stories and experiences that you can learn from.
And you don't have to listen to them all at once. Just pick a few episodes that seem relevant to your interests.
So it's about making it bite-sized and digestible, right?
Right. And you might even want to set aside some time each week to, read or listen to something new.
It's like building a habit. Consistency is key.
Exactly. And speaking of habits, get into the routine of evaluating your goals regularly. Ask yourself, what do I want to achieve in the next year?
Setting those intentions can really keep you focused.
And don't hesitate to adjust your goals as you learn more. Real estate is a journey. Things change, and so can your aspirations.
So true. And for those who might feel shy about reaching out, just remember, everyone started somewhere.
That's a great point. Most experienced investors are more than willing to share their knowledge, so don't be afraid to ask questions.
Yeah, just take that first step. Sometimes it's the hardest part, but it can lead to amazing opportunities.
And as you continue to learn and network, keep an eye out for potential syndication opportunities.
Right. It's all about building those relationships.
Exactly. So, with these tools and steps in your pocket, you're in a great position to move forward.
Let's recap what we've covered today.
Well, Sarah, as we wrap up our discussion on syndication, I think it's important to highlight a few key takeaways for our listeners.
Absolutely, Mike. One big point is that syndication allows investors to pool their resources, which can lead to access to larger deals that they might not be able to tackle alone.
Right, and another takeaway is the importance of choosing the right partners. It's crucial to align with people who share your goals and values,
Yeah, and don't forget about the value of due diligence. Investigating the property and the market can really make a difference in the success of the investment.
Exactly. And let's not overlook the potential for passive income. For many, syndication can be a way to earn returns without being actively involved in the day-to-day operations.
For sure. And ultimately, it's about building wealth strategically over time through informed decisions and strong partnerships.
That's a great way to put it, Sarah. Real estate investing, especially through syndication, can be a powerful tool for anyone looking to build long-term wealth.
Definitely. So if you found value in today's episode, we encourage you to like, subscribe, and share your biggest takeaway or any questions you might have in the comments.
And if you know someone over 40 who's interested in investing in property, sharing this episode could really help them out.
Absolutely. We want to spread the knowledge and empower more people to take control of their financial futures.
Next time, we'll dive into real estate crowdfunding options, which is another exciting way to invest in property.
So make sure to tune in for that.
Thanks for joining us today, everyone.
Yeah, thank you. We hope you feel inspired to take your next steps in real estate investing.
Until next time.
Take care.